Welcome back, everybody. Stocks closed at a record yesterday, with the Biden administration inheriting a full plate of policy challenges, including pushing through another round of stimulus. For a closer look at what it all means for the markets, let's welcome Rashir Sharma. He is Chief Global Strategist and Head of Emerging Markets with Morgan Stanley Investment Management. He's also the author of the book, The 10 Rules of Successful Nations, and his latest piece for the Financial Times is titled, Dear Joe Biden, Deficits Still Matter. Rashir, thank you for being here today. Let's talk about this. We know that the Biden's administration's kind of number one goal right now is trying to attack COVID and also get some additional funds out there. $1.9 trillion is the price tag that they're looking at right now. I'm guessing you think that's too much.
Yeah, Becky, I think that more than the exact price tag or the fact that they're putting more money to work now, I'm much more concerned by the thinking. As President Biden himself said, and the Treasury Secretary nominee Janet Yellen also said that because interest rates are so low, we can afford to spend big. I'm really concerned about that thinking, the thinking that all because interest rates are low, we can afford to keep piling on debt with no consequences. And what I've been arguing for, and I did so in this Financial Times op-ed again, was the fact that we are already paying the price of this increasing culture of taking on more and more debt and deficits by the fact that productivity is getting lower and lower with increased government involvement in the economy, with more and more bailouts. And also that a lot of the money in terms of stimulus that's put out there finds its way into financial assets, as we know, rather than into the real economy. So the two things that the rising deficit and debt culture of the last few years has been already causing is widening income inequality and lower productivity. And if we end up getting higher inflation in the future, that's obviously a much bigger concern. But so for me, it's this basic worry that all because interest rates are very low, we think we can keep spending with no consequences, whereas the consequences are there, just not in plain sight.
So basically, this is an argument against MMT, modern monetary theory, that it's okay to keep doing this, that there is eventually going to be a price to pay for all this. We're just not entirely sure when.
Yeah, no, I think that the point I'm making is that we are already paying a price for it, which is that why do we have lower and lower productivity over the last 10, 15, 20 years, despite the incredible tech boom that we are seeing? Why do we have a situation where the size of the financial economy today is 4 times larger than the size of the real economy compared to, let's say, in the 1980s, when the financial economy and the real economy were of the same size? So these policies of much more deficit spending, more debt, and the Fed being more and more accommodative to carry on that debt binge, I think that is already having a consequence. So that's my basic point, that most economists think that the consequence is only in the future when you get higher inflation. I'm saying, wait a minute, we already have consequences of this, just not consequences that are that visible. Why do we have so many zombie companies in the world today, where even in countries like the United States, 20% of all companies which are listed can be classified as zombie companies? That number used to be 2 or 3% a few decades ago. So this culture that we are of bailouts, of constantly, like helping increase government involvement
Let me
there's
stop you on that point. There's so much you're saying here that's so interesting, but let me just stop you on that one point. To say that 20% of the S&P 500 are zombie companies right now, would you put a company like United Airlines, like any of the airlines that aren't getting business because of the COVID shutdown there? Because that's an argument you can look at. These are not zombie companies that are going to be kept alive for forever. These are zombie companies that we're trying to hold up and get to the point where we're back to more normal. And hopefully we are on that path with these vaccinations rolling out now. Hopefully we'll get back to a more normal life quickly, and those companies can recover and do what they had done before.
Yes, that's true. So it's not about specific companies. Firstly, who's defining zombie companies? A zombie company is defined by institutions such as the Bank of International Settlement as companies that don't even earn enough interest from their profits, right, for 3 years in a row. So this is not just a one-off. This is for companies that are doing it systematically. And my point is that number has increased in a straight line from the 1980s or so, from a low of 2 or 3% to nearly 20% now. So it's this entire culture that, yes, every crisis can be justified for having more intervention, for this to be temporary. The problem is it doesn't stop. Once the crisis is over, these interventions, these support, these lifelines seem to continue forever. And which is why the number of new startups in the economy is declining. So it's not just about the pandemic and the intervention just now. It's this culture of constant intervention, even in good times, not just the bad times.
Shepard Smith here. Thanks for watching CNBC on YouTube.